Your money is not sitting in a vault. The second your paycheck lands in your account, the second you tap that deposit, it vanishes into a system so vast, so deliberately opaque, that even most bank employees couldn't fully explain it to you. And here is the fact that should stop you cold. For every dollar you deposit, your bank is permitted to lend that money out. And through a chain of redeposits and relending across the broader banking system, that original deposit can support a far larger volume of loans. This process, called fractional reserve banking, means your deposit does not sit idle. It becomes the raw material for mortgages, car loans, and credit card debt throughout the economy. That isn't a glitch. That is the entire design. And here is what we are going to uncover. There is a specific moment, a window of hours, sometimes minutes, where your money is doing something you were never told about. Something that generates substantial profits for institutions that pay you fractions of a percent in return. This is not a secret conspiracy. It is a standard, legally disclosed feature of how commercial banking works. But understanding it changes how you evaluate where to keep your money. By the time this is over, you will understand exactly why your savings account interest is almost insultingly low and what you can actually do about it today. Let's go back to the basics, because the basics are where the deception hides. When you deposit money at a commercial bank, you are not storing it, you are lending it. Legally, the moment that cash crosses the counter or that transfer clears, ownership shifts. The bank now owns your money. What you hold is a claim, a promise, that they will return it on demand. That promise is backed by the Federal Deposit Insurance Corporation, up to $250,000 per depositor per institution. Which sounds reassuring, until you understand what happens to the rest of it. This is where the case breaks open. Banks operate under a principle called fractional reserve banking. The Federal Reserve historically required banks to hold a fraction of deposits as reserves, a cushion against withdrawals, and lend the remainder out. In March of 2020, the Federal Reserve reduced that reserve requirement to 0% for all depository institutions. 0. That means, in strict regulatory terms, there is no federally mandated floor on how much of your deposit a bank must keep on hand. Gone. Now, banks do maintain voluntary and capital-based buffers. They are not lending every single dollar into thin air tonight. But the principle stands. Your deposit becomes fuel. It funds mortgages, auto loans, credit card debt, corporate lines of credit. The bank earns interest on that money, mortgage rates, auto loan rates, and credit card APRs that have historically ranged from the mid-single digits to well above 20%, depending on the product and the borrower. That interest flows back to the institution. You earn, in many major institutions, a fraction of a percent in return, a figure the FDIC tracks through its national rate survey, where traditional savings account averages have consistently remained well below 1% annually. That gap, that extraordinary, engineered gap, is called the net interest margin, and it is the single most profitable mechanism in modern finance. But there is another layer, one that operates while you sleep. Every night, banks participate in what is called the federal funds market, an overnight lending system where institutions with excess reserves lend to institutions that are short. These transactions happen in the dark hours between banking days. Hundreds of billions of dollars can move through this system on a single night, and the cumulative annual volume across the banking system is enormous. All of it governed by a single rate set by the Federal Reserve. The interest rate charged, the federal funds rate, is set by the Federal Reserve and influences virtually every other interest rate in the economy. Your mortgage, your car payment, your credit card minimum, all of it traces back to decisions made in a room you will never enter about money that was yours a few hours earlier. And this is the part nobody talks about. Your bank does not need your permission for any of this. It is written into the account agreement you signed, likely without reading, in language precise enough to be legally binding and vague enough to be practically invisible. Remember what I said at the start. It is working, constantly, aggressively, for someone else. So here's what you can actually do, right now, today, not as a protest, but as a move. High-yield savings accounts at FDIC-insured online banks have, in recent periods of elevated interest rates, offered annual percentage yields meaningfully higher than the national average, sometimes several times higher. Rates change, so checking current offers directly takes minutes and is worth doing before you move anything. That is not a gamble. That is simply choosing a different institution, one with lower overhead, no physical branches, and a need to compete for your deposit. According to FDIC national rate data, the average savings rate at traditional banks has remained well below 1%, often a fraction of that, even as market interest rates have climbed significantly. Moving your emergency fund to a high-yield account is a straightforward online task, and depending on where your money currently sits and where rates stand when you check, the difference in annual yield can be substantial. The FDIC National Rates page and any major rate comparison site will show you the gap in real time. No risk, no lockup, just a transfer. The system is not broken. It is functioning exactly as it was built to function. The question has always been the same one. Who is it functioning for? And maybe the more uncomfortable version of that question is this. Now that you know exactly what your bank does the second you deposit your money, are you going to keep letting them do it for free? This video is for educational and entertainment purposes only and does not constitute financial, legal, or investment advice. Always do your own research before making any financial decisions.